Namaskar, welcome back to the channel. I'm CA Jaydeep B. Vadher, and in today's video we're decoding something extremely crucial for every charitable trust and institution in India. The key legal provisions under the Income Tax Act 1961 that you simply can't afford to ignore. Let's begin with the basics. What exactly is a charitable purpose? As per Section 2(15), it includes relief of the poor, education, medical relief, preservation of the environment, protection of monuments, and advancement of any other object of general public utility. But here's a red flag. If your trust is involved in trade or business, that activity will not be considered charitable unless it directly supports the charitable objective and income from such activity does not exceed Rs 25 lakhs per annum. For any trust or institution to claim exemption under Sections 11 and 12, it must be registered under Section 12AB. Apply using Form 10A, ensure your objectives are genuinely charitable, and your activities must reflect that intent. Without this registration, no exemption is possible. If your total income, before claiming exemptions, crosses the basic limit, audit is mandatory. File Form 10B with your income tax return, and file under Section 139, 4A, to stay compliant. You need to apply at least 85% of your income to charitable or religious purposes. What about the rest? You can accumulate 15% without conditions. Want to accumulate more? Then, file Form 10, specify the purpose, invest only in approved modes under Section 11(5), and apply within the return due date. Donations with a specific direction to be part of the corpus? These are fully exempt, not subject to the 85% application rule, and you don't need to apply or audit them for tax purposes. Be cautious. Anonymous donations can attract 30% tax if they exceed Rs 1 lakh or 5% of total donations. Exemption applies to purely religious trusts, but not to charitable or mixed trusts. Running a business? It must be incidental to your charity, have separate books of account. Otherwise, you lose the tax exemption. All your accumulated funds must be invested in approved options like GovT, savings certificates, bank FDs, mutual funds, PSU bonds. Invest outside this list and exemption is gone under Section 13(1)(d). Your trust loses tax benefits under Sections 11 and 12 if income is applied for private religious purposes. It benefits a specific caste or religious group. Founders or trustees benefit from the income. Funds are not invested as per Section 11(5). Want your donors to get tax benefits? Register under Section 80G using Form 10G. Donors can claim 50% or 100% deduction, depending on your category. Trust must not benefit a specific community and must maintain proper audit and compliance. Here's a quick compliance checklist. Registration, mandatory under Section 12AB, audit, required if income exceeds exemption limit, return filing. File under Section 139, 4A, income application, 85% to charitable purpose, accumulation, max 15% or as per Form 10, donor records, maintained to avoid 30% tax, business income, only if incidental with separate books, investments, only in Section 11(5) modes, governance, no benefit to founders or trustees. Trust compliance isn't just about following rules. It's about protecting your vision for social good. Like this video if you found it useful. Subscribe to stay updated with tax, audit, and compliance tips, and comment below if you'd like a downloadable PDF version with all key points summarized for your board or compliance file. Thanks for watching. Jai Hind, and see you in the next video.